You know that feeling when you learn something that just completely reframes how you see the world? Especially something as huge as, well, fundamental as global finance.
Oh, absolutely.
Today, we're diving into exactly that. We're looking at how the very system designed to connect us, create immense wealth, also kind of systematically created these vulnerabilities on a scale that was previously unimaginable.
Yeah.
We're talking about the really defining financial frauds of the last, say, 50 years. And not just, isolated bad apples, rogue actors.
Right, not just one guy.
Exactly. More like problems that were almost baked right into a system designed for lightning speed and borderless money flow. So our mission today is to trace this evolution, see how each transformation, each change opened up what you might call a new attack surface for financial wrongdoing.
Okay.
So let's unpack this.
It really is fascinating. It's like this grand experiment, right? It offered incredible interconnectedness, amazing potential. But yeah, at the same time, it allowed for deceptions that the original architects of global finance back in the 40s, they could never have possibly envisioned.
Right.
And what's really striking is the dual revolution happening. You've got political ideologies basically tearing down regulatory walls, and simultaneously technological advances just handing over the tools to exploit the gaps that were left behind.
So let's go back. Imagine the world right after World War II. Everyone's still haunted by the Great Depression, the currency wars.
Yep.
It was chaos.
A real desire for order.
Exactly. And that's the backdrop for the Bretton Woods Conference in 1944. The goal wasn't dynamism, not growth at all costs.
Right.
It was stability.
Yeah.
Pure, unadulterated stability. To stop, as they put it, the ailments that had nearly paralyzed world trade.
Yeah.
This regulated world, it really felt like an impenetrable fortress. But I guess every fortress has its weak points, doesn't it? Even the strongest walls can erode, or maybe just get bypassed. What actually made that old system so effective at keeping finance, contained?
Well, you can sort of picture it as a series of national economic swimming pools.
Okay.
Each pool has its own lifeguard, clear walls. Capital couldn't just slosh freely between them. The Bretton Woods system, it rested on three main pillars for this kind of containment.
What were they?
Okay, first, a modified gold standard. The US dollar was pegged to gold at $35 an ounce. Other major currencies were then pegged to the dollar within a really narrow band, like 1%.
So stable exchange rates, predictable.
Exactly. Predictability was key.
Yeah.
Second, there was this implicit acceptance of capital controls. Countries actually had the power to restrict speculative money, hot money, flowing across borders, which was crucial for keeping those fixed exchange rates stable. As the economist Barry Eichengreen noted, the whole setup relied on low international capital mobility, tight financial regulation, and the dominant economic position of the United States and the dollar.
Right. America was kind of the anchor.
The anchor, precisely.
Right.
And the third pillar, well, they created institutions like the International Monetary Fund, the IMF, and the World Bank. The IMF was there to oversee the rules, provide short-term loans, and the World Bank focused on long-term reconstruction.
So this was really financial containment by design. Things moved slower. They were more transparent to national regulators.
It's more transparent.
And just inherently less vulnerable to the kind of complex cross-border fraud that, well, that came later.
Exactly. Finance was meant to serve national goals, not the other way around.
But that fortress, as strong as it seemed, it wasn't going to last, was it? What were the first signs that this financial containment was starting to crack?
Yeah, the cracks really started to appear in the late 1960s. You had the costs of the Vietnam War, big domestic spending programs in the U.S.
Right, the Great Society.
Leading to U.S. inflation. And that inflation slowly started to undermine the dollar's gold backing. It made the $35 peg look increasingly shaky. Then came the big one, August 15th, 1971. The Nixon Shock. President Nixon just unilaterally severed the dollar's convertibility to gold. Just like that.
Pulled the plug.
And by 1973, the whole system of fixed rates collapsed. Major currencies were floating freely against each other, and that ushered in an age of, well, volatility, but also innovation, lots of financial innovation.
But it wasn't just an economic shift, was it? There was something else going on, an ideological change.
Absolutely. This coincided with a really powerful ideological shift. The 1970s saw stagflation, that nasty mix of high inflation and high unemployment.
Yeah, debilitating.
And it really discredited the post-war Keynesian consensus, the idea that governments should actively manage the economy. A new faith, almost, in free market economics took hold, championed by leaders like Ronald Reagan in the U.S., Margaret Thatcher in the U.K.
Right, the whole government is the problem idea.
Exactly. The prevailing belief became that government was the problem, and market discipline was a much more efficient, more effective regulator. It was a profound shift in thinking.
And this ideological sea change, it basically unleashed a wave of financial deregulation, particularly in the U.S. You had laws like DIDMCA in 1980, Garn-St. Germain in 82. They systematically dismantled banking regulations. And one key change I remember was phasing out Regulation Q. That was the rule capping interest rates banks could pay on deposits, right?
That's right. And phasing out Reg Q created what was, looking back, a disastrous flaw, especially for the savings and loan institutions, the S&Ls.
The S&L crisis, yeah.
Removing Regulation Q forced them to compete for deposits by offering higher rates. They had to survive. But to pay those higher rates, they had to earn higher returns.
So they took on more risk.
Exactly. They were pushed into much riskier ventures, things they had no experience in, like commercial real estate, junk bonds.
But wait, wasn't their deposit insurance still in place? Like, from the federal government?
Yes. And that's the crucial point. The federal deposit insurance remained. This created a classic moral hazard.
Okay, explain moral hazard again.
It's basically heads I win, tails you lose. S&L owners could gamble with federally insured public money. If the risky bets paid off, they kept the profits, privatized gains.
Right.
If the bets failed, the government, meaning taxpayers, picked up the tab, socialized losses. It was, frankly, an open invitation for fraud and excessive risk-taking.
A ticking time bomb.
Pretty much. And running completely in parallel with this regulatory rollback was a massive technological revolution.
Computers, telecom.
Yeah, advances in computing, software, telecommunications. They drastically cut the cost and increased the speed of financial information. Transactions that used to take days involving physical paper could now happen instantaneously across the globe.
Dissolving geography and time?
Totally. Global gross capital flows, the sheer amount of money moving around, quadrupled in the 1990s alone.
Wow.
So if you connect these two trends, the removal of regulatory walls, right, combined with technology basically annihilating the physical barrier.
Leave a gap.
You get a critical vulnerability gap.
Yeah.
The speed and complexity of financial innovation just completely outpaced the regulator's ability to understand it, let alone keep up. It was a perfect storm, a new financial landscape, less regulated and, in practice, much harder to regulate.
It sounds like an open invitation for a new kind of financial crime.
It absolutely was. The deep insight here is that while technology brought incredible efficiency, it also starkly revealed how much the old system actually relied on physical slowness, on friction, for oversight.
So this new, interconnected, fast-paced financial world quickly became a proving ground for frauds on a scale never seen before. And our first big case study here, the Bank of Credit and Commerce International.
BCCI.
BCCI, often called the world's first global criminal enterprise.
That's quite a title.
And it earned it. BCCI's entire model was built on exploiting this new lack of global regulation, this fragmented oversight. Founded in 1972, it was deliberately structured as this impossibly complex spiderweb.
A maze.
A maze of entities spread across 73 countries, with key operations deliberately placed in secrecy havens like Luxembourg, the Cayman Islands, places known for banking secrecy.
Hide things.
Exactly.
Yep.
This opacity, this lack of transparency, allowed it to become essentially a full-service financial supermarket for criminals.
Wow. Like what?
Think money laundering for the Medellin drug cartel, financing arms deals for terrorist groups like Abu Nidal, bribing officials worldwide, moving flight capital for dictators like Panama's Manuel Noriega. It even managed to illegally infiltrate U.S. banks.
Unbelievable. So how did it end? It ended dramatically. In 1991, there was this coordinated raid across 7 countries simultaneously. The collapse of BCCI was a huge global event. Its black hole of missing funds was estimated somewhere between $10 and $20 billion.
Billion with a B. So what did this mean for ordinary people, for, the depositors?
Devastation. Around 1 million depositors, many of them in developing nations, lost everything. Their life savings, gone, with no government safety net like we have in the US or UK.
Oh, terrible.
Even innocent BCCI employees faced, reputational ruin just by association.
So a wake-up call for regulators.
The brutal wake-up call. It turned out Agencies like the U.S. Federal Reserve actually had troubling information about BCCI for years.
Years?
Yes, but they failed to act decisively or coordinate effectively with other international regulators. The response afterwards included the Foreign Bank Supervision Enhancement Act, FBSEA in the U.S. That dramatically increased the Fed's authority over foreign banks operating on U.S. soil. And internationally, the Basel Committee on Banking Supervision established the principle of consolidated supervision.
What's that mean?
It means a single home country regulator must oversee an entire global banking group, all its branches and subsidiaries worldwide. It was a direct response to how BCCI had exploited the gaps between national regulators.
So the realization was, if capital is global, supervision has to be global too.
Precisely, or at least much better coordinated. The stark insight from BCCI is that when capital crosses borders effortlessly, supervision must follow. Otherwise, the cracks just become chasms for criminals to fall into.
So BCCI showed how global deregulation opened up these huge international attack surfaces. But was this permeability, this leakiness, also allowing problems to fester within supposedly solid national systems, like closer to home in corporate America?
Oh, absolutely. The rot, as you put it, had definitely taken hold domestically, too. And the poster child for that was Enron.
Enron. Yeah, everyone remembers Enron.
Enron was really a fraud born from a specific culture. Hyper-competitive, deregulated, and absolutely obsessed with smooth, constantly increasing quarterly earnings. Wall Street demanded it.
So how do they fake it?
They used breathtakingly complex accounting fraud. A key part was this web of off-balance sheet entities called special purpose entities, or SPEs.
SPEs?
Think of them as like financial shell companies. Enron created hundreds of them, often with flimsy justifications, primarily to hide billions of dollars in debt off its main balance sheet so investors wouldn't see it.
Like sweeping debt under the rug.
Exactly, a very complex rug. They also abused something called mark-to-market accounting.
Mark-to-market.
It allows companies to book the current market value of assets. But Enron took it to an extreme, booking hypothetical, hoped-for future profits from long-term energy contracts as if they were real income today.
Counting chickens years before they hatched.
Precisely. And this entire massive deception was enabled, even encouraged, by their auditor, Arthur Andersen.
Yeah, auditor. Weren't they supposed to stop this?
They were supposed to be the independent watchdog. But Arthur Andersen not only blessed Enron's dodgy accounting, they were also making huge fees from consulting work for Enron. A massive conflict of interest. And when the investigation started, Andersen employees notoriously shredded tons of incriminating documents.
Unbelievable. The fallout must have been huge.
Immense. At Enron itself, 25,000 employees lost their jobs. Many saw their entire retirement savings, heavily invested in Enron stock, just vanished overnight.
Devastating.
Over $70 billion in shareholder value, poof, gone. And the collateral damage was the death of Arthur Andersen itself. Once one of the big 5 global accounting firms, it was forced to essentially cease operations. 85,000 of their employees lost their jobs worldwide.
Wow. So it wasn't just Enron that collapsed.
No. And the insight here isn't just about a few rogue executives. It's about how the watchdogs themselves, the auditors, could become complicit when their own financial incentives were so badly misaligned with their duty to the public.
So what was the response? More regulation.
Massive public outrage spurred a swift political response. The Sarbanes-Oxley Act of 2002, often just called SOX.
SOX, right. What did it do?
Key things. It required CEOs and CFOs to personally certify the accuracy of their company's financial statements, making them potentially criminally liable for fraud.
Oh, come on the hook personally.
Exactly. It also created a new body, the Public Company Accounting Oversight Board, PCAOB, to oversee the auditors themselves. And it sharply restricted the lucrative non-auditing services, like consulting, that accounting firms could provide to the companies they audited, trying to reduce those conflicts of interest.
So trying to legislate accountability.
Essentially, yes. The key insight from Enron and the SOX response is really about how easily a corporate culture focused solely on relentless growth, on hitting the numbers at all costs, can corrupt the essential checks and balances that are supposed to protect investors and the public.
So the scandals of the early 2000s, like Enron, WorldCom, they seemed like maybe bad companies, outliers, but then came 2008.
2008.
And that revealed something far more terrifying, didn't it? That fraud wasn't just an occasional problem and aberration. It had become, well, almost the central feature of the system's most profitable activities. The Great Recession wasn't just a crisis. It was a crisis built on systemic fraud.
That's exactly right. Systemic is the key word. It wasn't isolated pockets.
That betrayal of trust feels so profound. Looking back, it seems like it went from the street-level mortgage brokers all the way up to the biggest banks and the rating agencies. Was it just a few bad actors, or did the whole structure, the incentives, make that kind of deception almost inevitable?
That's a great question. And it really gets to the heart of why 2008 was so different. It wasn't just a few bad apples. It was more like the whole orchard was, if not rotten, then certainly incentivized towards recklessness. It was an ecosystem.
An ecosystem of fraud.
In many ways, yes. Everyone had an incentive to pass the hot potato down the line, maybe assuming, deep down, that the government would have to step in if it all went wrong.
So where did it start?
It really started at the street level. Mortgage originators, driven by fees, abandoned traditional underwriting standards. They started churning out subprime loans to borrowers with poor credit history, often with predatory terms, like exploding interest rates.
Okay.
Then, Wall Street investment banks took these often poorly underwritten, risky mortgages and industrialized the process. They bundled thousands of them together.
Securitization.
Exactly. Into complex financial instruments like residential mortgage-backed securities, RMBS, and even more complex ones called collateralized debt obligations, CDOs.
Layers upon layers.
Layers upon layers. And the fraud was one of massive misrepresentation. The banks packaging these things often knew, or should have known, how poor the quality of the underlying loans was. But they marketed these securities as safe investments.
And the rating agencies. Moody's, S&P.
Critically, the credit rating agencies who were paid by the very banks issuing these securities.
Another conflict of interest.
A huge one. They slapped AAA ratings, the safest possible rating, on vast quantities of what turned out to be, frankly, financial poison. The structure itself almost became an accomplice in the deception.
The impact was just a global economic catastrophe. The U.S. housing bubble bursts. The value of these mortgage-backed securities plummets.
And the contagion spread like wildfire through the interconnected global financial system. Banks stopped trusting each other. Credit markets froze. It brought the entire system to the very brink of collapse in September 2008 with the failure of Lehman Brothers.
And the result? Millions lost their homes, unemployment soared globally.
And governments had to step in with massive taxpayer-funded bailouts like the $700 billion TARP program in the U.S. just to prevent a complete meltdown.
So what was the regulatory response this time? Dodd-Frank.
Yes, the U.S. government responded with the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. It was a huge, sprawling piece of legislation aimed squarely at preventing another systemic collapse.
What were its main goals?
Key parts included creating an orderly liquidation authority, basically, a way to dismantle huge, failing financial firms without causing system-wide panic, unlike Lehman. It established the Financial Stability Oversight Council, FSOC, to monitor the system for emerging threats.
Trying to look ahead.
Trying to be more proactive, yes. It introduced the Volcker Rule, named after former Fed Chair Paul Volcker, aimed at curbing risky speculative trading by banks with their own capital. And significantly, it created the Consumer Financial Protection Bureau, the CFPB.
CFPB, right.
Acknowledging that individual consumers needed a dedicated watchdog specifically focused on protecting them from predatory financial products. Dodd-Frank was essentially an admission that systemic risk was the new central challenge. The deep insight from 2008 is just how dangerous unchecked financial innovation can become when it's combined with perverse incentives and arguably regulatory capture, where regulators become too close to the industry they oversee. It can literally threaten the global economy.
And just as these huge systemic frauds were coming into the light, a completely different kind of deception was revealed. Something more personal, perhaps, but just as staggering. Bernard Madoff.
Madoff, yes. A different beast entirely, but equally devastating in its own way.
This wasn't about complex derivatives, was it? It was much older school.
Absolutely. Madoff ran the largest and longest-running Ponzi scheme in history. It wasn't technologically complex at all. At its core, it was the classic, brutal, robbing Peter to pay Paul structure.
He wasn't actually trading.
He apparently never made a single trade for his advisory clients. He just took in new investors' money and used it to pay fake returns to earlier investors.
So how did he keep it going for so long? Decades.
Through a powerful illusion of legitimacy and exclusivity, Madoff had cultivated this impeccable reputation. He was a former chairman of the NASDAQ Hughes stock market, a respected Wall Street pioneer, a philanthropist.
Someone you'd trust?
Exactly. He leveraged that trust brilliantly. His firm sent out meticulously falsified account statements month after month, year after year, showing impossibly smooth, steady, positive returns, even when the market was tanking.
Too good to be true.
It was. But people believed it because of who he was, the exclusivity of getting into his fund. It's like serving stale bread, but on a beautiful silver platter with impeccable service. People bought the presentation.
And the collapse, triggered by 2008.
Yes, the 2008 crisis was the trigger. As markets panicked, investors wanted their money back, redemptions spiked. But there was no money to give back because it was never really invested. The scheme imploded.
The impact must have been catastrophic on a personal level.
Deeply catastrophic. Thousands of individuals, many retirees, lost their entire life savings. Hundreds of charities, foundations, university endowments were wiped out or severely damaged. It was also what's called an affinity fraud. He preyed heavily on his own social and religious networks, particularly the Jewish community. It exploited trust within tight-knit groups, destroying not just finances, but relationships and community bonds.
And the regulators, where were they?
That's perhaps the most damning part of the Madoff story. It stands as one of the most egregious cases of regulatory failure imaginable. The U.S. Securities and Exchange Commission, the SEC, received numerous credible warnings and detailed complaints about Madoff for over a decade.
A decade.
Yes, most notably from a financial analyst named Harry Markopolos, who basically laid out the whole scheme. Yet the SEC conducted 5 separate examinations or investigations over the years and somehow failed to uncover the blatant fraud.
How is that possible?
An internal investigation by the SEC's Inspector General after the collapse pointed to incompetence, poor coordination, lack of follow-through, and frankly, a degree of deference to Madoff's powerful stature. They seemed unwilling to believe someone like him could be running a simple Ponzi scheme.
Okay, consequences for the SEC.
Yes, it led to significant internal reforms at the SEC, efforts to improve examination procedures, and also strengthen whistleblower protections under Dodd-Frank, partly inspired by Markopolos' experience. The profound insight from Madoff is chilling. Even the oldest, simplest scams can thrive and reach enormous scale when credibility is weaponized and regulators fail to challenge powerful figures, even when the warning signs are blinking red.
So as the world was still absorbing Madoffs, the globalization of financial crime just kept evolving, didn't it?
Yes.
We had the LIBOR scandal, 1MDB. These felt different again.
They absolutely were. Different mechanisms, different impacts. LIBOR, the London interbank offered rate, was arguably the most important number in global finance at the time.
Why? What did it do?
It was the benchmark interest rate underpinning literally hundreds of trillions of dollars worth of financial products worldwide. Mortgages, student loans, derivatives. Countless contracts were priced off LIBOR.
Okay, crucial number. What was the scandal?
The scandal revealed that traders at many of the world's largest banks had been colluding for years, secretly manipulating their daily LIBOR submissions.
Manipulating it? How? Why?
They'd nudge their submissions up or down by tiny amounts. Sometimes to make their bank look financially healthier than it was, especially during the 2008 crisis. Other times, simply to benefit their own trading positions that were linked to LIBOR. Small changes could mean millions in profits.
So how is that possible?
The fatal flaw was that LIBOR wasn't based on actual borrowing transactions. It was based on banks' estimates of what they thought they could borrow at. An honor system, essentially.
An invitation to fudge the numbers.
An irresistible incentive to lie when your bonus depended on it. The key insight from LIBOR is just how easily trust can be betrayed when self-regulation or an honor system is the only thing guarding a fundamental pillar of the financial system.
And 1MDB. That sounds different again.
Very different. The 1MDB scandal wasn't about manipulating markets, it was about outright theft. A brazen case of kleptocracy ruled by thieves.
Kleptocracy.
Around $4.5 billion was systematically siphoned out of One Malaysia Development Berhad, a Malaysian state investment fund supposedly meant for economic development.
Stolen by who?
By corrupt Malaysian officials, allegedly led by the Prime Minister himself, working with complicit financiers. The money was laundered through a dizzying global network of shell companies, offshore accounts, and transactions involving major international financial institutions.
What was the money used for?
Funding an unimaginably lavish lifestyle for the conspirators and their associates. Luxury real estate, yachts, private jets, fine art, financing Hollywood movies like The Wolf of Wall Street.
Ironically.
Deeply ironic. And this scandal exposed the deep complicity of major global players. Most notably, Goldman Sachs, which earned huge fees underwriting billions in bonds for 1MDB, allegedly while ignoring numerous red flags about where the money was really going.
Goldman got caught up.
Yes, they ended up paying billions in fines and admitting wrongdoing by their Malaysian subsidiary. The insight from 1MDB is really about the persistent vulnerability of the global financial system to being used as a pipeline for large-scale corruption and money laundering, especially when powerful institutions perhaps prioritize profits over rigorous due diligence.
So this history of financial fraud really shows a clear pattern, doesn't it?
Mm-hmm.
Criminals are relentless innovators. They adapt. So if those were the breaches of yesterday and the day before, what's the new attack surface today? What are the big vulnerabilities we're facing right now?
Well, the leading edge, the area causing the most concern right now, is undoubtedly cybercrime, and specifically within that, the ecosystem around cryptocurrency.
Cybercrime generally.
Yes. Cybercrime is probably the single biggest fraud threat overall. Phishing scams trying to steal your passwords, ransomware attacks holding data hostage, sophisticated identity theft. It's often run by transnational criminal syndicates operating like businesses, using crime as a service model. They leverage technology for incredible scale and speed.
And crypto fits into this how?
Cryptocurrency has created a powerful new ecosystem that facilitates a lot of this crime. Its key features pseudo-anonymity, its decentralized nature, the ease of borderless transfers make it highly attractive for laundering the proceeds of other crimes, like ransomware demands, and for making illicit payments for things like drugs or weapons.
How do they hide the money trail?
Criminals use tools like mixers or tumblers, which basically jumble transactions together to obscure the source and destination of funds. They also use privacy coins like Monero, which are designed specifically to make tracing transactions extremely difficult.
And the scams within crypto itself.
Oh, yeah. The largely unregulated nature of much of the crypto space also makes it fertile ground for old-fashioned scams just dressed up in new technological clothes. Classic Ponzi schemes promising unrealistic returns, rug pulls, or exit scams where developers hype a project and then disappear with the investors' money. It's rampant.
So the deep insight is that these technologies, while promising efficiency and maybe decentralization, have also inadvertently created these perfect playgrounds for illicit activity.
Exactly. Playgrounds that are really challenging the traditional methods of law enforcement and regulation, which are often based on national borders and centralized institutions.
So looking even further ahead, what's the next frontier? We hear a lot about artificial intelligence, quantum computing. Are these the next tools for fraud?
They absolutely are, but it's a double-edged sword. These technologies have enormous potential for both defense and offense in the financial crime battle.
Okay, how for defense?
For defense, AI is already being used. It can analyze massive data sets of transactions in real time, identify subtle patterns that indicate fraud far faster and more accurately than humans ever could. It can proactively flag suspicious activity, maybe even prevent fraud before it happens.
And quantum computing?
Quantum computing offers this almost unimaginable leap in processing power. It could potentially simulate incredibly complex financial networks to predict where vulnerabilities might emerge, or perhaps help crack complex money laundering schemes.
But the flip side,
Yeah.
the offense.
The flip side is that these same powerful technologies will inevitably be weaponized by criminals. AI can be used to create hyper-realistic deepfake scams. Imagine a video call from your boss telling you to wire money, but it's completely fake. AI can also design novel forms of malware that are much harder for current systems to detect.
And the quantum threat, that sounds serious.
It is potentially the most profound long-term threat. The concern is a cryptographically relevant quantum computer. That's a quantum computer powerful enough to break the public key encryption algorithms.
The ones that protect basically everything.
Pretty much everything secure online today. Online banking, secure communications, digital signatures, all rely on encryption that current computers can't break, but a powerful enough quantum computer could, in theory.
So they could just steal everything.
It raises the terrifying prospect of harvest now, decrypt later attacks. Criminals or hostile states could be stealing encrypted financial data today, data they can't yet read, stockpiling it with the expectation that they'll be able to decrypt it once quantum computers become powerful enough in the future.
Wow, that's unsettling. So what's being done?
This looming quantum threat is forcing governments and financial institutions worldwide to start the incredibly complex and expensive process of transitioning to new forms of encryption known as quantum-resistant or post-quantum cryptography. New algorithms believed to be secure even against future quantum computers.
So it's a race against time, really.
It absolutely is a very high-stakes race. The key insight, I think, is that the very tools we develop for progress inevitably open new doors for exploitation. The contest isn't just about catching today's criminals. It's about anticipating and defending against the technological frontiers they'll inevitably try to conquer next.
This deep dive, looking back at the history of financial fraud in this age of globalization, it really is a story of this perpetual contest, isn't it? This dynamic push and pull between innovation and control.
Absolutely. From the moment Bretton Woods was dismantled, paving the way for free-flowing capital, right up to the emergence of AI and the looming quantum threat, the pace of technological and financial innovation has consistently, almost inevitably, outstripped the pace of regulation.
And every major scandal, we talked about BCCI, Enron, the 2008 crisis, Madoff, they all served as these painful lessons, right? Triggering big reforms.
Significant reforms, yes, but fundamentally reactive reforms. Sarbanes-Oxley, Dodd-Frank, these weren't proactive blueprints for a stable future. They were scar tissue forming over past wounds.
So the dark side of globalization, this potential for large-scale fraud, it isn't really a problem you can definitively solve.
I don't think so. It seems more like a permanent condition that has to be constantly managed. The path forward, if there is one, probably demands a shift. Moving away from just reactive crisis management towards building more proactive resilience into the system itself.
Which requires what?
Constant vigilance, certainly. Much more robust international cooperation between regulators because the money doesn't respect borders. And a genuinely forward-looking approach, trying to anticipate where the next vulnerabilities might emerge rather than just fighting the last war.
Because that permeable fortress of global finance, it seems it will never be truly impregnable. And the contest to secure it, well, it looks like it will have no end. So what will be the next major breach? And how will we be forced to adapt yet again? Maybe the most important question for you, our listener, is what role do individuals even play in this ongoing battle for financial security and integrity? Something to consider, I think, as you navigate this incredibly complex financial world.